Hey guys, what is up? It's your boy Vijalarazzi here, and today we are getting into my Beginner's Guide to Cryptocurrency series, part number 5. How to Trading with Indicators. If you haven't watched my last videos in the series, I highly recommend that you go back and watch those. They're full of really great content that's going to really help you and benefit your trading as a whole. Lots of really good educational material there. Okay guys, so let's just get right into this. Why is it important to use indicators? Well, number one, they give you extra data to confirm a trade. Number two, more data for different trading strategies. And number three, when unsure of the market direction, indicators can give you another perspective that candlestick charts can't by themselves. So this is going to help you get a little bit more of a confirmation. I know when you're getting into trading, some of this can be a little bit difficult, but these are going to be able to kind of add to whatever strategies you already have. So there's going to be indicators for trends, momentum, and just there's basically indicators for everything. But I hope that by the end of this video, I'll be able to simplify it down enough to where you kind of have a little bit better of an understanding of what an indicator is and how they can benefit you in your trading practices. What you will learn: number one, what is an indicator? Number two, examples of how to use indicators. Number three, my favorite indicators. And number four, how to apply them to your trading plan. Okay, so there's some rules of indicators, but before we get into that, I want to read what the definition of an indicator is. A technical indicator is a mathematical calculation that can be applied to a cryptocurrency's past price patterns. Meaning, if we take all of the grouped data of price history of a certain crypto and we look at how it's reacted in the past, we can maybe come up to a conclusion on how it's going to react in the future or in the present moment of the market itself. What purposes do they serve? They alert a trader about a trend, they predict the direction of future markets, and they confirm TA made by another indicator. Two categories of indicators, okay? There's leading, which gives trade signals when the trend is about to start, and then there's lagging, those that follow price action. These two categories basically contain every indicator that there is. The different types of indicators, and this is what you'll use, this is the different strategies in which you can trade them with. There are trend indicators, momentum indicators, volatility indicators, and volume indicators. And all four of those indicators fall in between the leading and lagging categories. Okay guys, so here's a couple examples of indicators. This is the Ichimoku cloud, which is actually a trend indicator. It shows support and resistance as well. And then this little lagging span is a moving average, which also is a trend indicator. Anytime price rides above it, you can see that it maintains this green colored, and anytime price breaks below this moving average, it becomes resistance and turns red. And then down here at the bottom, you have the very classic volume indicator. That's a given to anybody's chart. If you're not trading with the volume indicator, then you are missing out on a huge fundamental practice of trading. So I'm going to transition to my screen here and we'll get right into it. For this video, I'm only going to cover one of my favorite indicators for each of the four indicator classes. Meaning I'll cover one for volatility, trend, momentum, and volume. How about we start with the trend? Now, one of my favorite trend indicators to use is actually just moving averages. The one I have on my screen here is actually the 100-week moving average. A lot of the times with these cryptos is at the terminal end of their corrections, they'll come down and either touch the 100-week or get very close to. And so anytime it gets close to that, I find myself taking buying actions along the retest of the 100-week. As you can see here, we had the first market cycle, prices retraced, and then fell just above that 100-week moving average. And then we had another rally. And then the same thing, prices retrace and fall just above. However, this second time around, we actually managed to get a retest of that 100-week moving average. So personally, I find the 100-week as one of the very best trend indicators to use because of the fact that when a lot of these altcoins retrace, they come all the way down and basically retest that. So anytime prices get close to that 100-week moving average, that's usually a good signal that it's time to be taking buying actions. Next, we'll take a look at a volatility indicator known as Bollinger Bands. Now, Bollinger Bands are fun because they almost resemble trends at the same time as a volatility indicator. So, in times of great volatility, there's lots of swings going on, and Bollinger Bands are great because they can help you they can help you adjust to what the market's doing so that you can stay ahead and know when to enter and exit the market. What I mean by that is during times where prices are rallying and going very high in the market and there's lots of volatility, prices aren't going to be breaking above these Bollinger Bands very often. In fact, they only break above and out of these Bollinger Bands about 20% of the time. So 80% of the time, they're maintaining trajectory inside of these bands. Now, Bollinger Bands are a little bit better to use in shorter time frames, mainly because they're better for these swing trading events. If we come in here, I'll show you how Bollinger Bands also affect the trend. To explain Bollinger Bands, you have an upper band, a middle band, and a lower band, okay? In an uptrend, in a bullish market, prices will maintain support above this red moving average. Occasionally they peak out a little bit, but for the most part they're staying inside of these Bollinger Bands. Anytime prices hitting this upper Bollinger Band, that indicates that the market is overbought. You should expect a possible retrace to come. This will happen throughout the bull market. You will get support on this 20-day moving average, and then we'll come to retest this upper Bollinger Band, and then we'll repeat that all the way through. Now, once prices break through this middle Bollinger Band, that shows that the trend has reversed. In this case, prices fall, and then we go to retest this lower Bollinger Band. And then the cycle repeats. We'll have a retest of this lower Bollinger Band, and then we'll come up and test this mid Bollinger Band, and then we'll fall again. We'll fall to the lower Bollinger Band, and then this indicates the price is extremely oversold, and then we'll rally to this middle Bollinger Band. And if prices can't maintain, it's the same thing. So in a downtrending market, we'll have tests of this lower Bollinger Band and then tests of this middle moving average. And anytime prices come down to touch this lower Bollinger Band, it's oversold. Anytime prices come to retest this upper Bollinger Band, it's overbought. So another thing to look out for with Bollinger Bands is anytime you get a tight squeeze of these bands, that shows that there's going to be a big move coming one way or the other, whether it's a dump and it goes bearish, or in this case, we had a breakout and prices went bullish and made a new market cycle. So something to watch out for, when these Bollinger Bands squeeze, that usually signals that there's a big move coming one way or the other. We've covered my favorite trend indicator as well as my favorite volatility indicator. Now, how about we check out a momentum indicator? Now, let's get rid of these Bollinger Bands here. The RSI indicates whether the market is overbought or oversold. And it oscillates between these two dotted lines, these two gray dotted lines that you see here. Anytime prices touch this upper dotted line, that means the market is overvalued, and you should expect that prices will eventually come back down on the downside and retrace. However, when markets come down and touch this lower dotted line, that indicates that the market is extremely oversold. You should expect a bounce and a momentary rally in the market itself. So I use these mainly to get entries and exits. It helps me to time when the market is good for buying or when I should be laddering out and taking profits in a bull run. We can see that price came down and we were extremely oversold and touched this point here. So that would be a buy signal based off of my indication. So let's go take a look and see where that would actually put us in the overall market cycle picture. So this oversold bounce down here would have actually put us at basically the very low and the terminal end of this first leg market correction before we went into a much bigger expansive two-wave. So this is why it's extremely important to watch this, is because anytime you have extremely oversold conditions, that's usually a great indication that it's time to be taking buying actions, and at least taking small positions and laddering in is a good idea. However, at that same time, when prices rally and they become extremely oversold, then that's a good time to be taking your profits. Now, one thing to keep in mind when it comes to trading the RSI is that in a bullish market, prices can maintain oversold, meaning if a market comes to oversold in a bull market, it can retest that oversold boundary line multiple times before you end up getting a retrace. Just because prices come up and retest that oversold boundary line of the RSI, it doesn't mean you need to be exiting and selling all of your position. That just means for the short term, prices are extremely overbought, and you could expect that prices may retrace out of that high. And it's vice versa. Same thing for a bear market. If we're in a bear market, you can expect to see that prices are going to be bouncing and maintaining that oversold boundary line a lot more than if we were in a bull market. So just because if we're in a bear market, just because the price comes down and touches oversold doesn't mean you need to be buying and taking all of your positions at that one spot. Be ladder in so you're not stuck buying all at one time. Lastly, I wanted to talk about a volume indicator, and that is what is known as the Chaikin oscillator. So with this one, what you're looking for is bearish and bullish divergences. And what I mean by that is I'll draw you an example. So a bearish divergence is when price rallies and then gets rejected and makes a lower high and then falls. So this lower high and resistance would have actually been your bearish divergence, signaling that the market is going to go lower. Now, a bullish divergence is when prices are getting pushed down and then they bounce. They make a higher low before they start going up again. And this trending support here, this higher low, would have actually been a bullish signal. So this is what you're looking for when you're trading the Chaikin oscillator. And basically what it does is the Chaikin shows the total money coming in and out of the market. So as you can see, during this huge bull run, we had lots of new money coming into this market, as shown by the Chaikin money oscillator. Once prices retraced and came back down, a lot of the money started leaving the market rather drastically. So this one, the best way to trade this is to look for these bearish and bullish divergences, whether you're trying to short the market or go long. So let's see if we can actually spot a few of these and show you what I'm talking about. Here's an example of a bullish divergence. Now, we can see that price made this lower low and then bounced and then maintained, made this higher low on top of trending support. Now, if we come and look at the regular candlestick graph, we'll probably be able to see how this signal spotted an early reversal signal in the market itself. This higher low would have been the first bullish indicator saying that this trend is reversing. Now, the best way to see it is you want to see on the candlestick graph, you want to see lower lows, and then on the Chaikin money oscillator, you want to see lower highs. Now, when you see lower lows on the candlestick price and then you see lower highs on the indicator, that's a very strong bullish indication that the trend is going to reverse. And what did we happen shortly after? The trend reversed and went on the upside. Now, the same rules apply in a bullish market. So let's see if we can come in here and find a bearish divergence. So this is actually an example of a bearish divergence. We had this higher high and then we made a lower high before we fell. Now let's go see if we can take a look and see where that would have put us in the overall market. This lower high would have put us at about right up here in the market. So this would have gave us a perfect sell zone to where we could have taken profits in this bull rally. We could have taken profits here and then wait until this momentum oscillator hits a bottom before we start re-entering, or support on the candlestick graph. This is why this oscillator can be really helpful. It can show you when the trend is going to reverse and go bullish, or vice versa. It can show you when it's a good time to be taking profits out. Thank you guys so much for watching this video. If you found this video helpful, always remember to leave a like, comment, and subscribe to my channel for further updates. I will be posting more in the future, so you can count on some more content to come. Thank you guys so much for watching. I'll catch you guys in the next one. Peace.